Hey there, my savvy investors. Iggy the Investing Iguana here, and do I have some sizzling news for you. In this video, we're going to take a deep dive into the scorching world of Singapore banking stocks. DBS, OCBC, and UOB, these three giants are on fire, and I'm not just talking about the weather in Singapore. We'll explore why these stocks are hitting record highs and what's fueling their incredible growth. I'll break down how high interest rates are padding these banks' profits and how that translates into mouth-watering dividends for shareholders like you and me. But here's the real question: is it time for you to jump on this banking bandwagon? Stick around, because I'm going to give you the inside scoop on these three banking behemoths and help you decide if they deserve a spot in your portfolio. Let's dive in. Singapore stocks hit two-year high. The Singapore stock market is absolutely sizzling right now, soaring to heights not seen in the past 2 years. You might be wondering, what's the secret sauce behind this incredible surge? Well, a big part of it comes down to the banking sector. Investors are feeling mighty optimistic about the potential for hefty dividend payouts from the big banks. On top of that, there's a growing sense that the U.S. Federal Reserve is going to keep interest rates elevated for a good while longer. When we look at the individual players, it's clear that DBS Group and OCBC are the stars of the show. These two banking behemoths have been on an absolute tear, with their share prices smashing through record highs like there's no tomorrow. But let's not forget about UOB. They're not content to sit on the sidelines. UOB stock has also been on a serious upswing, reaching levels not seen in more than 2 years. So what's the big deal about high interest rates, you ask? Well, it's pretty simple. When interest rates are high, banks can charge more for loans while still paying out relatively low interest on deposits. That means fatter profit margins and more money in the bank's coffers. And when banks are raking in the dough, investors start to get excited about the potential for bigger dividends. Of course, we can't ignore the fact that Singapore's economy is looking pretty robust overall. The country has bounced back strongly from the pandemic, with key sectors like manufacturing and exports showing solid growth. That's providing a nice tailwind for the stock market in general. Why high interest rates are great for banks? Now, you might be wondering, Iggy, why are high interest rates so fantastic for banks? Well, my young investing Padawans, it's actually quite straightforward when you break it down. You see, when interest rates start climbing, banks have the opportunity to rake in more dough on their investments. Here's how it works: banks pay their customers a certain interest rate on their deposits, right? But then, they turn around and invest that very same money at higher rates, pocketing the difference for themselves. It's like a big old cha-ching for the banks. Think of it this way: imagine you're a bank and you're holding onto $1 billion in deposits from your customers. You're paying them a modest 1% interest annually, but then you take that billion and invest it in short-term notes that earn you a juicy 2%. Boom! You've just made $20 million from your customers' accounts, but you only had to pay out $10 million to them. That's a tidy $10 million profit right there. Now, let's say the central bank decides to hike up rates by 1%, pushing the federal funds rate from 2% to 3%. Suddenly, your yield on customer accounts jumps to a whopping $30 million, while you're still only paying out that $10 million to your customers. Even if you end up having to raise your deposit interest rates a bit due to the persistently high rates, most of your customers probably won't bother seeking out better returns elsewhere. They'll stick with you, and you'll keep raking in the profits. Of course, there's always the chance that rates could climb too high, and that could actually backfire on the banks. If borrowing becomes too expensive, people and businesses might decide to take out fewer loans, which could put a damper on the lending side of the banking biz. But for now, the banks are absolutely loving these high interest rates. It's not just about the immediate profits, though. When interest rates go up, it usually means the economy is in pretty good shape. Businesses are expanding, consumers are spending more freely, and the demand for loans is on the rise. All of this is fantastic news for banks, as they can earn even more from a thriving lending market. Plus, when rates are high, the gap between long-term and short-term rates tends to widen. This is a real boon for banks that borrow short-term and lend long-term. They can take advantage of this spread and watch their profits soar. Dividends, dividends, dividends. The cherry on top of this interest rate sundae is the potential for mouth-watering dividends. As banks rake in higher profits thanks to elevated interest rates, they have more cash to distribute to their shareholders. And let me tell you, the dividends from Singapore's banking giants are looking absolutely scrumptious right now. Take OCBC for example. This banking behemoth is projected to have a jaw-dropping 12-month dividend yield of 5.6%. That's like getting a delicious 5.6% bonus on top of any stock price appreciation. To put that in perspective, the average dividend yield for Asia-Pacific financial companies is only around 4.3%. OCBC is leaving them in the dust, but OCBC isn't the only one dishing out tasty dividends. DBS, Singapore's largest bank, has a projected 12-month dividend yield of around 5.09%. And not to be outdone, UOB is expected to deliver a yield of approximately 5.62%. These banks are in a league of their own when it comes to rewarding shareholders, so not only are investors benefiting from rising stock prices as these banks capitalize on high interest rates, but they're also getting a generous serving of dividends on top of that. It's like having your cake and eating it too, but here's the best part. Analysts expect these juicy dividend yields to continue, as Singapore's banks are well capitalized and poised to benefit from the rising interest rate environment for some time to come. So if you're looking for a solid income-generating investment, Singapore's banking stocks might just be the perfect addition to your portfolio. All right, my investing friends, we've covered a lot of ground today. We've seen how DBS, OCBC, and UOB are riding the high interest rate wave to record profits and dishing out dividends like candy on Halloween. These banking stocks are on fire, and it's no wonder investors are flocking to them like moths to a flame. But remember, investing isn't just about chasing the hottest stocks. It's about building a diversified portfolio that can weather any storm. So while Singapore bank stocks are definitely worth considering, make sure you do your own research and think about how they fit into your overall investing strategy. If you found this video helpful, give it a big thumbs up and share it with your friends. And if you want more sizzling investing insights, smash that subscribe button and ring the notification bell. Join the Investing Iguana community and let's navigate the investing jungle together. Until next time, this is Iggy the Investing Iguana, reminding you to stay savvy, stay diversified, and keep on investing. See you in the next video.